Welcome out to Tackle Trading's halftime report for June 1st, 2022. Navigating a little bit of a downward movement in price here today. And I have the great Coach Tyler Craig, master technician, author of Jedi Options, Tales of a Technician, and many other things to tackle trading on the show here today. Tyler, let's first start with some pleasantries. Tyler, how you doing today, my friend?
Matt, I bought an electric lawnmower yesterday, and I feel like I just got a new Cadillac. It's pretty nice. It's pretty nice.
It's amazing. It's the simple and the small things in life that make us happy, isn't it? It's not those big things. It's little tiny small things added up.
I don't even care about this down day, man. Bring it on. Bring it on. I got an electric lawnmower. Let's do this.
Jamie Dimon can talk about bracing yourself all you want. Tyler Craig's got an electric lawnmower, everybody. Let's go. Yep. Tyler, navigating a little bit of a downward movement in price here today in the S&P. And, when I have you on the show, I really want to focus on the technical read of the marketplace. And that's something you and I put a lot of time and a lot of thought into, is the technical read of multiple different time frames. And so I want to start big picture here today. And the reason I want to start a little bit of a bigger picture is the market is fighting through some important resistance zones. And you do have a downward slant in the marketplace, and you have a downward moving price from a weekly perspective, but there are improvements happening on that daily chart that we do need to discuss. But one of the reasons I want to start bigger picture here today is because of some of Jamie Dimon's comments out of JP Morgan earlier today. The market was actually, really quickly, Ty, if you'll go into that intraday market just very quickly, kind of looking at that big downward movement in price, that spike. Now that spike in price happened not at the cash open. The cash open was a little bit volatile, but it was kind of a normal cash open. Jamie Dimon's commentary about an hour after the cash open, when he gave an interview and he talked about, you better brace yourself. There could be a hard landing coming. He was talking economically. He talked about how JP Morgan is being very conservative with their balance sheet. And he talked a lot about the things that we are all talking about today. Increasing inflation, the potential of the Fed not being able to navigate that soft landing, and where they do create a recessionary environment, or hypothetically that stagflationary environment. That's what he's talking about. These conversations are very well known to many market participants. So I don't think he added anything new from a conversation perspective, but it certainly did bring back into the light, things are pretty nasty economically right now. And like we talked about, we've been seeing an improving technical condition, but nothing has really changed from an overall economic perspective or a behavioral perspective. And so once again, I don't think he added anything new to the conversation, just kind of brought that back into the forefront of all of our minds. There is the potential of a pretty nasty, difficult, hard landing. And so I want to start on the big picture here, Tyler, from a weekly chart perspective, and then kind of bring it down to what needs to transpire on that daily chart to really change the perspective of the marketplace from a bigger picture perspective, i.e. that weekly chart. Give me a read here.
Yeah, this is going to illustrate the technical analysis principle that larger time frames trump. Longer term trends, longer term support and resistance levels are more important, more significant. They carry more weight than what's going on in smaller time frames. And so to Matt's point, you don't want to lose sight of the bigger picture. This is why it pays to take time to look every once in a while at the weekly. You don't have to do it every day because it doesn't change that often, right? But I think this is a good starting point, Matt. So look, last week was significant for a couple of reasons. First of all, we were down 7 straight weeks. 7 weeks in a row is a lot. It's a long time going down. So we've been due. We finally got a relief rally, and last week's candle formed a pivot low. We changed the swing trajectory from down to up. The problem is you're still in a downtrend, right? So we formed a pivot, but we didn't change the long-term trend. And that's where this rally is suspect on the larger time frame. You're coming into old support pivots. Old support could potentially become new resistance. You have a declining 20 MA. You can draw some descending trend lines here. So there's work to be done on the big picture, which is why you have to temper your enthusiasm a little bit. As great as last week was, it's a start, but we need more. And it also illustrates that there's some conflict between the bigger picture, the weekly chart, and the daily chart, because as we'll look at here in a second, the daily chart's starting to look a little more constructive, but the weekly chart's not there yet. And so we're in this in-between period, Matt, where daily's trying to get it done, get back into an uptrend. Weekly's not there yet. And so it's a battle. And when you have conflicting signals like that, you got to be a little more cautious, right? You can't make big swings because you don't have things in an alignment. So for me on the weekly, to button this up, we're encountering some overhead resistance. We've got the declining 20 MA. We just need time, Matt. I need time and more follow through to get this thing higher.
And to have that weekly chart actually improve, it does have to start with that intraday coming into the daily chart. And after last week's, epic rally by the bulls, up the S&P is up over 6% last week, punching up against some pretty decent momentum moving averages, the 90 MA coming down, the 20 SMA coming down. Market rallies, recovers both of those two momentum moving averages, working its way back up on the daily chart. Let's work into that daily chart now. And so you have an improving condition from a short-term technical perspective, following that double bottom in the market, the choppy, volatile creation of support right around that 3,900 level. Market starts punching up. The very important 90 MA crosses up, starts smiling at us. You start to see an improving condition. And even with the downward movement in price over the last couple of days, I don't think that's too surprising to technicians out there, given the fact that the rally, was pretty impressive last week. You got a little bit overextended and you're coming into some major resistance levels, especially on the weekly chart. Doesn't surprise me to see a little profit taking here. It doesn't surprise me to see a little bit of a downward movement in price. But what do you need from this daily chart? Paint me a picture here, Tyler, because as a technician, I love painting pictures so that I can, build my expectation of what do I need to see to really increase my bias, to increase it. Because right now, even with the improving condition, we're still negative 45 at tackle trading on the S&P. What needs to transpire to get that to 50, to get that to positive 45, and then obviously to start the process of moving those rankings up for you?
I need follow through. I need a continuation in this reversal process. It's like bulls have a foothold, okay, but they need more. They need to defend the territory that they have acquired, right? And so this double bottom, I don't want to go back there. Don't go back there. Don't go back to the low again. Make a higher low. Show me that demand is increasing. I would love this to stop pretty quick here, Matt. like right here would be nice.
Like give us a doji tomorrow.
Give us a doji tomorrow. Defend this 90 MA. Let what was resistance and a signifier of the downtrend become support and a signifier of an uptrend. Don't break back below the 20. I don't want to see this go back below the 20 MA, really.
I think it's the 20 SMA for me as well.
Yeah.
I mean, for that weekly chart to actually improve, you need to see an increasing support level here, because if all you do is come right back down and test support, it doesn't mean we're not going to see that reversal. It just means you need more time in that reversal. And so for that weekly chart to really improve in the short term, I'm with you. I think the market has to find some semblance of support here. And the most logical area on this chart right now is that 90 MA, is that 20 SMA, and the little tiny pocket in between that 9 and the 20. Keep an eye on that level. You increase support there, you pivot there, you got a short-term bullish uptrend at that point. At that point, the market has a chance to reverse the course and break through that weekly resistance area. So stay with us as we break down that market throughout every halftime report every day on our Tackle Trading YouTube channel. If you've been enjoying the show, give us a nice little like and share, and definitely tell your friends about Tackle Trading, as we love to help other people navigate the financial world on a daily basis as well. Let's take a little picture at some of the commodities in the market here. Crude oil first, if you don't mind, Tyler.
Yeah, so crude was interesting. Yesterday, you had this really big breakout. Yesterday morning, energy was rocking, crude oil was rocking. Couldn't hold it, Matt. And yesterday, the energy sector was down pretty bad. It didn't go anywhere. See, that's the thing with crude oil, right? It's like, listen, my kind of fake out is I'll go up and come back, but I ain't going down. Come on, I'm going sideways. This remains constructive for me. I'm impressed that it rallied back today after pretty sharp intraday rejection yesterday. It remains bullish. It remains strong. And to me, that you got to remain constructive on energy when you get this kind of bar after what could have been a nasty bearish, downswing after yesterday's rejection.
That's actually a really nasty candle from yesterday when you got that bullish upward movement in price. You're breaking out a resistance zone, and then all of a sudden on the intraday, it just gives it right back. It just puts a lot of caution. It's a lot of red flags from a technical perspective. So it is very, again, I think the crude oil is more about how energy behaves with crude oil right now, but I do find it compelling that on a day after we saw that rejection of the resistance level, crude oil stabilizes a little bit, no doubt about that. Let's move on into the precious metals area of the market. Let's take a look at gold here, Tyler. Fighting the 200-day moving average yesterday, a little bit of a downward movement of price. Market selling off a little bit, gold's picking up. That shouldn't shock anybody at tackle trading. What's your read here technically, Tyler, as we look for perhaps an increasing support level off that 200-day moving average?
Yeah, look, this is a good example of what you want to see if you're bullish and you want more constructive price action. You had some pretty weak rallies on the way down. This rally was stronger. You took out the 9, you took out the 20. It's kind of like the market, the S&P, put in a double bottom, give me a higher low. Gold paving the way, right? Gold showing what that looks like. This could have rolled over, Matt, continued the downtrend. And I'm putting a lot of weight in today's candle so far, assuming this sticks. This is an example of bulls increasing in aggression and buying quicker on the current dip versus the last one. It's good, man. It's good. I'd like to see a breakout. Obviously, we need some more follow through here, but the first signs that this could be a failed bear retracement. You give me a bear stop out day, breakout over resistance, and you got the making of a nice little trend reversal there.
I certainly agree with that. It is compelling a little bit to see that increasing support level. Pretty bullish in terms of the inflationary protection and the protection against the market. Those are both very bullish tailwinds for gold. But once again, if the market does recover, I expect some stabilization in gold. Let's see if the market recovers, though. It's got some tests. And again, one thing we have yet to see this year in the marketplace is the actual confirmation of a short-term increase in support level that actually creates a trend. We have yet to see that. And that's pretty rare for the first 6 months of an entire year to not see that. And so this would be the first in the year. So let's see it. Let's just not hope for it. Okay. Let's take a look at, typically we go into stocks in the news right now, Tyler, but we don't look at all the different metals and all the different commodities, but I do want to take a look at copper here /HG, please. Copper is from an economic perspective, copper kind of drives with the economy. It's very cyclical like that. China's reopening their economy. They've had some positive news from an economic perspective. Copper is very weighted on that type of analysis. And the reason I want to bring it up, Ty, is we got some recovery analysis here in copper. You got an increasing support, and you got a potential breakout with a 1, 2, 3 victory formation here. And you also, in conjunction with that, you have FCX fighting up against the 200-day moving average. I want to get your double take here, Tyler, from a technical perspective. Am I reading too much here? Copper, potential breakout, FCX breakout of the 200-day moving average. Give me your read.
Yeah, I could go either way on this one, right? So the skeptic would say, listen, bro, this has been chopping sideways for 6 months. You could have read into a lot of breakouts over the last 6 months, and it was all just a sloppy sideways range, right?
Yep.
However, isn't this what you want to see? Did you want copper to keep crumbling? No, because of the implications of global growth and everything. Listen, I'm happy this found support. I'm happy you're getting more constructive price action. I would like the S&P also to take note of copper. Okay, pull a gold, pull a copper, do something like that, S&P. And yeah, I do like it. I mean, the challenge obviously is a breakout in the middle of a long-term range. There's just a lot of baggage overhead, right? And so I love the constructive nature. Like, would this normally be a trade for me on this kind of chart? No, but FCX is an easier trading vehicle, right? If this can get over 200, sure. I'm starting to warm to it, but yeah, I stability more than anything for me, but there could be something there on that breakout.
Yeah, I just wanted to get your quick technical read as I was looking at copper earlier today. And obviously, whenever we think of copper, a lot of times we're thinking about FCX being that copper vehicle we use in the marketplace quite a bit as a proxy. Let's take a look at stocks in the news here today, Tyler. First and foremost, let's talk about earnings out of CRM. Salesforce reported earnings last night, and they are gapping up, a little bit of a gap up, coming into some major resistance with that 50 period moving average and an old pivot point from a historical perspective. Very much looking forward to getting your technical read on CRM here, Dow component CRM. Earnings coming out of CRM was mixed, but overall positive given what they did with guidance. The EPS number came in at 98 cents versus 94. Revenue came in right in line at 7.4 billion. That represented about 24% increase in revenue year over year. Their guidance was mixed as well. So a little bit mixed on their EPS versus the revenue numbers. They did lower short-term guidance, which we have seen quite a few times in the recent earnings season, given the fact that a lot of the concern about inflation and how aggressive the central bank is going to become in the face of that inflationary mandate. That concern is over the next 3, 4, 5 months. And so CRM, they lowered their short-term guidance. And then the hope is if we are seeing peak inflation, as the economy starts opening back up, as supply chains start improving, the yearly guidance will improve there as well. That's CRM's hope. They lower the short-term guidance. They did raise full year guidance here. That's the gap up, the raising of the full year guidance. Now let's talk about the technical read here as CRM's doing a little bit of rounding bottom, now punching up with the recent earnings report. What's your read, Ty?
Yeah, this is tough. It's suffering from the same problem plaguing so many other stocks. There's just a lot of overhead resistance, right? And so when you gap up into an overhead resistance level, listen, there's a lot of bag holders that are like, I'll see you later. Thanks for the overnight 15% recovery. And obviously the chart, the candle tells the tale, right? I mean, listen, it tried to break above the 50 and it didn't work. And now the challenge is you got this big unfilled gap that could act as a magnet. So I think it needs time. And I'm interested maybe in the next test of the 50 MA for a breakout. I wouldn't short it because there's so many easier stocks to short than one that had a nice pump off of earnings. But you got to give this some time, look for a secondary pattern. I don't like buying the dip as much as I like buying the breakout because of what it would signify for the overall trend reversal. So put an alert around today's high, and if it gets back up there, I'm interested. Otherwise, give it time.
Yeah, I agree. Probably does need some time. A gap fill would increase short-term support, put a little pressure on that next breakout potential against the weekly chart. I certainly agree with that. Let's move on. Let's talk about HPQ as they also report earnings here today, 108 versus the 106 expectation. So we're going to start EPS. We're going to start on an EPS beat with the earnings on HPQ. Revenue also topped the expectation, 16.5 versus 16.1 billion. That did only represent about a 4% increase in revenue year over year. They maintained all guidance, both quarterly and yearly. They maintained, but they did raise their profit outlook within their guidance. And basically what that did is it raised their lower end of their guidance up. So when you see the report that HPQ raises guidance, it's actually the profit outlook that is being raised. So the lower end of the guidance gets raised, top end stays the same. HPQ looks to be making more money over the course of the next year. Doesn't on the daily chart, doesn't really interest me at all. Weekly chart though analysis, you're talking about a potential breakout here. What's your read, Ty?
I agree with you. The weekly chart, obviously, it's because the weekly chart cleans up the chop, right? Doesn't look as messy as that daily chart. And it's like, hey, color me interested. The challenge I have is because the daily is straight up 6 bars. You have these prior 2 episodes where it did, blip its head above resistance. I want this to chill for a minute. Don't break out this time, HP. Just chill, okay? Just relish today's victory. Give it some time. Let the 9 catch up. Let the 20 catch up. Let's break out in a few days. Break out next week. I like it better.
Little hesitation analysis. Hesitate, let the momentum catch up to it, then break and run. Confirm that both that daily and the weekly. I agree. Good technical read there on HBQ. Quick journey through the skyline today is not a lot of information coming into the market. Had a couple economic reports that were mixed, but overall, very light news day in the market here today, and really wanted to focus on the technical read from a weekly to a daily perspective in the market. Keep an eye on that increasing support level and the test against the 9 EMA coming up for the S&P. That's a pretty important short-term momentum test if the market can take a punch. I think the market, I think market participants will become a little bit more confident if the market can take a punch over the next, over the last 2 days, increase support, show a little bit of slowing momentum. So keep an eye on that market as we test that 9 EMA. And over the next week, again, I feel like the last 2 weeks or the last week, this week, I feel they're 2 very important technical weeks because, again, we have not had a lot of opportunities in the market for an increasing support level. Market punching up last week, testing support this week. We got to pass those tests. You got to pass those tests. If you cannot pass those tests, it's very tough for that weekly chart. It's very tough for any market participant to change their bias that aggressively, as long as that weekly chart still has that downward sloping bearish downtrend in it. Tyler, with that said, let's move on into Jedi Options. And I know you're going to be talking a little bit about order entry, using orders as a way to enter into option positions. And, Ty, we've done a lot of Jedi Options. We've done a lot of content, you and I, at Tackle Trading over the years. And I'm going to tell you, one of the things that I feel is really important for people is order entry. And I also feel one of the more confusing things, especially with options, is order entry. So I'm looking forward to this edition of Jedi Options as you help our community break down orders in regards to trading options. Take it away.
Thanks, Matt. Yeah, to your point, it's easy to get the theory, oh, this is a call option, this is a naked put. But then you fire up your brokerage account and you try to place the trade. And it's like, what the heck? I don't even know how to get this thing filled. So it is an art, and it is a skill you got to develop to understand how to properly put in the order, get it filled. And listen, there's a lot of different types of strategies, but in reality, the process of getting an order filled, knowing what price to ask for, knowing if it's realistic, that's universal. It's the same across the board. So we've got to refresh our memory on just a few core concepts here, and then I'll dig into options in particular. So first of all, remember, there is not one price. There are 2 prices for every vehicle, and this is a unique concept actually, because in the real world, when you go to the grocery store, there aren't 2 prices for milk. There aren't 2 prices for gas. There's one price, and you got to pay it. If you want to buy it, you got to buy it. But see, in the real world, you're not usually selling things, right? I mean, usually I'm thinking of it as a consumer. You're just buying things, and there's one price, the price you can buy at. Well, in the options market, in the stock market, we're often on both sides of that equation. We're more often sellers than we are in our normal life. So there's a different price for buyers than there are for sellers. And the difference between the two tells you something about liquidity and the popularity of that instrument. So let's dig into here. So you've got a bid price and you have an ask price. Okay. And the bid, this is the price that you can sell it for, the price you can sell for. And the ask is the price you can buy for. Okay. So we buy the ask, we sell the bid. We buy the ask, we sell the bid. And if you take a look, again, at any instrument, which I'm going to pull open just a stock here. Apple, right here, Apple stock, there's a bid price of 148.15 and an ask price of 148.16. Well, listen, because Apple is liquid, it's a 1 penny difference. It ain't much. It's not much. But there is a difference. There is a penny difference. So it's like, listen, if you want to buy this, you're not buying at 148.11. You're buying at 148.12. Now, a penny doesn't matter on a stock like Apple because, as you can see, it's jumping around so much. It's not a big deal. but that spread between the bid and the ask widens in the options market and becomes a more significant factor. Okay. So in the case of Apple, 148.11, let's say, is the bid, and 148.12 is the ask. If I'm putting in a buy order and I'm buying at market, they're going to fill me probably at 148.12. Okay. If I'm putting in a sell order and I'm selling at market, I'm probably going to sell at 148.11. Let's look at an option. Let's say I'm not playing with Apple stock. I'm playing with an Apple option. June, I'm looking to buy a call option here. Apple's at 148. Maybe I want to buy the 149 call option. Well, again, you have a bid price. You have an ask price. 425. And again, it's flopping around here. 430 by 425. That's a 5-cent spread. 5 cents is still great, but it is 5 times more than the bid-ask spread of the stock. Okay, so a little bit wider bid-ask spread. It has greater significance in the outcome of the trade because there's a greater deficit you have to overcome to break even. In other words, if you buy this for 430 and then 1 second later you turn around and sell it, you can't sell it for 430. You have to sell it for 425. So the bid-ask spread, if you bought the ask and sold the bid, that's how much you're in the hole right off the bat. So if you're trading a product with a wide bid-ask spread, usually it's a byproduct of being illiquid. It's not super popular. And you have this big deficit. So normally we think, oh, I just got in, so I'm at break even right off the bat. That's true with a liquid product. With an illiquid product, you're not at break even right off the bat. You actually start negative. You got to overcome that bid-ask spread to get back to even. Okay, so let's look at this 425 by 430. So here's an option: bid 425, ask 430. So we would say that's a 5-cent bid-ask spread. I've also heard it called a 5-cent bid-ask differential, if you want to sound smart. Bid-ask differential of 5 cents. Again, I can buy at 430 and I got to sell at 425. Wouldn't it be nice if you could split the difference? Say, listen, man, I don't want to buy at 430. How about you give me a deal? Let me buy it at the midpoint. So in between the bid and the ask, there's this mid, short for midpoint. In this case, it would be $4.27.5. Now, we don't trade at half-cent increments, so it would be 427 or 428, but just go with me here. Let's say it's 427 as the midpoint. Usually, you can buy and sell at the midpoint. Okay, that shrinks essentially the amount of loss you have right off the bat. So usually we're not buying and selling, buy at the ask, sell at the bid, using market orders or even limit orders. Usually we're trying to shave it and buy a little bit less than the ask and sell a little bit higher than the bid just to get the best fill possible. Okay, so usually you can buy and sell at the midpoint, and usually you will get filled. Okay, now oftentimes these days, most options trade in penny increments. So for instance, if I want to come in here and buy this call option on Apple, okay, I click on the ask price. See, the software knows if you're clicking on the ask, you're buying because you buy the ask. Click on the bid, you're selling because you sell the bid. So it knows whichever one you click on, it's going to bring up the appropriate order. So I want to buy the June 149 call. It is defaulting to buying at the ask price. Now down here at the bottom, what is this NAT? And what is this mid? Well, new vocabulary term here, okay? And I don't know why they programmed it this way. If it were me, if Tyler ran the world, your life would be easier because I would have programmed it different. But basically, there is a natural NAT, which is essentially short for the natural bid. There is a midpoint price, and then there's a natural offer. Offer sometimes is synonymous with ask, okay? I'm just going to say NAT ask. So basically, they abbreviate it. So in the case of Apple, it's $4.25 is the bid. The mid would be, as we said, 427.5, and then the natural ask would be 430. Okay. Well, they just take out the ask part, they take out the bid part, and then it just looks something like this. Okay. And you only see two sides of it. So if you're buying, it'll show you the midpoint and the natural. So it's like showing you this section of this entire spectrum, right? If I were to change this to sell, at the bottom, they would show you the midpoint on the right and the bid price over here, right? So when you're buying, you see this half of the diagram. When you're selling, you see this half. So I'm buying. And again, the price is flipping around here a little bit. So it's saying, okay, you can buy at the ask, which is whatever it is. Okay, in this case, 435. In my example, it's 430. Or you can buy at the midpoint. Okay. If you were selling, it would default to selling at the bid price, and it would show you the midpoint on the right. Okay. What's the point? What's the takeaway? Well, first of all, it's just to familiarize you with the screen, but it's also to help you understand what the heck NAT is. If NAT is on the left, it's the bid price. If NAT is on the right, it's the ask price. Okay. Well, listen, by default, in Thinkorswim, by default, if you buy a call or put, okay, it defaults, to use the word twice, to the ask price. Okay. Or if you sell a call or put, it defaults to the bid price. So again, let me restart. I come into the 149 call. Now it's 435 by 440. Okay, click on the ask price. It is defaulting to the ask price. Okay, right now it's 435. It's saying buy it at 435. It's not defaulting to the midpoint, unfortunately. In this case, it shows it is, but it's not. Okay. So what? Well, listen, I would change the order to try and get filled at the midpoint. Okay. And if you can't get filled at the midpoint, then you can pay up, but it doesn't hurt to ask. Okay. It doesn't hurt to ask. So just in general, best practice, if you're trying to buy something, in this case, it's a call and a put. If whatever you're trying to buy, the order defaults to the ask price, listen, if you're super anxious to get in and you're like, oh, screw it, I don't even care, I just want in, fine, buy it at the ask. But if you're being a little more strategic and tactical, you want to try to buy it at the midpoint. Okay, now there's no guarantee you're going to get filled at the midpoint, but I'm just telling you, usually you do. I'll show you what to do if you don't. Okay, but let's finish this out. So for Apple, this is bouncing around so much, I think I'm probably going to get filled no matter what I put in. But the midpoint is, 430 was the midpoint a second ago. Now notice actually that this is not letting me go in penny increments, is it? Okay. I might be able to override it and put in like $4 and 32 cents or 31 cents. But the minimal interval that it's adjusting if I click up or down is 5 cents. Okay. And I haven't traded Apple options recently, so I can't remember if it's going to let you get filled in penny increments. But if the 5 cent intervals does not stick you at the midpoint, you can always see if they'll change in penny increments. Whatever. I'm going to get filled at 430. I'm going to put in 430. Okay. Confirm and send. Does it fill? So see right here is a good visual. 425 by 430. It was 435 a second ago. Listen, if I'm buying at 430, I should get filled because that's the ask price. Okay. Is it filling? Well, right now, no. And sometimes, the paper money is not perfectly accurate as to, replicating what it would be in real life, because this order is not actually being routed to a real exchange. It's not actually impacting the supply and demand for that contract, right? It's just trying to replicate it. Listen, I didn't get filled. What do I do? Well, right click, cancel, replace. I can say, fine, you didn't give me 430. I'll pay 435. Confirm and send. So I started at the midpoint. It didn't fill me. So I said, fine, move it closer to the ask price. In this case, I moved it to the ask price and it filled me. Okay. That is the art of order entry. Start at the mid. When you're buying, if you don't get filled, raise the price a little. Okay. When you're selling, start at the mid. If you don't get filled, lower the price a little. It's your choice as to how long you wait. I just changed that within 5 seconds because I'm trying to cut a video and teach a principle here. Would I have waited a little longer in real life? Maybe. Honestly, it depends on what the stock is doing. If the stock's ripping higher, I may be tripping over pennies, tripping over dollars to pick up pennies, right? Like sometimes it's like, listen, you're being too stubborn. And while you've been waiting, trying to save a nickel, the option value went up 25 cents. You should have just got in. So kind of depends on how quick the stock's moving and how anxious you are to enter. Second concept here, real quick. Spreads are different with bid and ask and what it defaults to. It will default to the midpoint with a spread trade. So like with Apple, let's say I want to do a bull puts. Actually, I'm going to change this. Let me go to SPY, because SPY options do trade in penny increments. And you can see that reflected in the option chain. Let's say I want to do a bull put spread in the S&P. I want to sell the 400 put and buy the 395. Okay. Now notice the price, $1.51, is the midpoint. I'm selling this spread. If this was a single option, it would have defaulted to the bid. It would have said sell it for 144. But see, they're nice. They're like, listen, we know you want the best fill. You're building a spread. We'll just assume you want the midpoint. I say, well, thank you very much. You should have assumed that when I bought the call and the put. I don't know why you didn't, but it's defaulting to the midpoint. So often when you build a spread trade, you don't even have to adjust the price. It already centers it right between the bid and ask. And what's lovely about SPY is look how close these prices are. The bid is $1.48. The midpoint was $1.50, right? Which means the ask would have been $1.52 at that point. So very, very tight bid-ask spreads. I actually would just take whatever the midpoint is and try to get filled there, right? Say, all right, good. Give me that fill price. Give me the $1.52. That was the midpoint. If it doesn't fill, all right, I guess either I wait and see if it does fill, or I come in. And the nice thing here is this is the working orders. This is the price I'm asking for. This is the current value. So I kind of know, I'm asking for higher than the midpoint. It adjusted right after I put it in. Okay, that's why they're not filling. They'll give me $1.48. I'm asking for $1.52. Okay, well, I mean, I need to see if the market fluctuates enough over the next 5-10 minutes to get me to $1.52. If it doesn't, I'm like, listen, I just want in, okay? Cancel, replace, walk it down. The new midpoint is $1.47. Okay, normally it doesn't change by 5 cents in a second like that, but say, okay, fine, give me the new price. Oh, okay, we'll give you $1.50. See, they even filled it better than what I asked. I asked for like $1.47. They filled me at $1.50. Good. That's what a limit order is supposed to do. Fill me at this price or better. It's just they rarely give you the or better, right? So, okay, I just got filled. Final point. I see a lot of traders that they go through all this hassle of building the order out. They put it in and then they go away. And then they come back at the end of the day and they're like, oh, I didn't get filled. The stock went in the right direction. I guess I missed it. It didn't fill my order. It's like, well, listen, you got to tend this a little bit. You got to massage it a little bit. Take an extra minute or two after you put the order in. And if you really want to get filled, modify it. It's very common that you got to modify the order once or twice to get filled because you're asking for the best price, the midpoint right off the bat. And sometimes you don't get filled there. Sometimes because the market changed after you put it in. So it really isn't the midpoint anymore. And other times just because the bid-ask spread's wide enough that midpoint's a moving target. And sometimes you don't get it on the first pass. And that's okay. And so you do that and then it becomes second nature, becomes easy. But in your head, you just got to remember bid, ask, midpoint. You just got to massage it around the mid and eventually you'll get filled.
Tyler, thank you again for such a wonderful edition of Jedi Options. Always appreciate your detailed thoughts. And that's what I love about every one of these tackle shorts. We call them tackle shorts and they're 15, 20-minute amazing lessons. We do a 2-hour webinar and it's 3 hours of great educational content. We like to go over time. There's no doubt about that. So appreciate your detailed thoughts on order entry. And it can be if even for traders that have been around the market for a while, order entry can be a little bit of an overwhelming concept to truly understand and grasp. So really appreciate your thoughts there, Tyler. Later on tonight, we got an edition of Trade Masters coming to our YouTube channel. And I believe Coach Pearl as well as Coach Mark are going to be on Trade Masters later on today. So definitely check that out in the Tackle Trading YouTube channel. I believe that is at 7 p.m. Eastern. Right? 7 p.m. Eastern Standard Time each and every Wednesday. So look forward to that later on today. Tyler, you also have a trading lab coming up. Talk about your trading lab a little bit and give us a little bit of a pitch for it. I love your trading lab. Let's get more people in it.
Yeah, Team Phoenix, listen, we have a good time. You're crazy if you don't join. You're just crazy. We do the best we can at entertaining you, educating you, and helping you make money in this market. This is not an easy market, okay? It's not an easy market, but there are techniques and best practices you can use to stack the odds in your favor and to recover. I mean, we've taken some bumps and bruises. I don't know how you don't when what happened in April and May happened, right? When the market drops as much as it does from an uptrend, right? Because it did get into an uptrend in March. So we had to practice some trade management techniques, but the emphasis for me in Team Phoenix is trade management. Okay. Doesn't take a genius to buy a stock. Doesn't take a rocket scientist to enter an order, contrary to what it might have seemed today. It's what you do when you're in that matters. And so my whole focus is both to let you peek over my shoulder and see what I'm doing and thinking, but also to understand the best practices and management techniques to rescue trades. I'm writing an article right now for Options Theory blog, Matt, it'll come out tomorrow, on an AMD trade we did, where we were wrong at the beginning and we had to manage it for a month or two. And with the recent recovery, we've effectively made back almost all of our money. So dead wrong at the beginning, okay, but found a way to rescue it. And ultimately, that's the magic. That's the secret sauce. And those are the things that are on display every week and every day in Discord in the Team Phoenix channel.
Love it, Tyler. Definitely check out Coach Tyler's Team Phoenix and all trading labs at Tackle Trading. And if you have any questions about trading labs, you can email us at team@tackletrading.com. With that said, we are done for the first day of trading day of the month in June, navigating a little bit of a pullback here. Stay with us tomorrow as we navigate, perhaps, maybe, hypothetically, a doji.
We'll see. Doji. Don't you tempt me.
We'll see you tomorrow. We'll see you tomorrow.